After about 9, 10 years of our market not moving, a lot of people have been asking, like, are we there yet? Is the bull market finally here? Has the market bottomed? Especially after hitting 4,000 3 years ago. Um, before I answer that, I just want to give a brief background on how things have changed from the last presentation. And sad to say is that things got worse. Um, you Previously you'd see some green boxes here, but now it's mostly yellow and red. But I'll explain why this is not that bad in the context of medium to long term investment. But just to get ahead of myself a little bit, 2Q GDP was not good, and the peso went from 54 to 57. Hence these red boxes here. Corporate earnings are probably going to be sub 20% growth this year. Inflation is not slowing down as much as expected. You've seen the headlines. Interest rates look like there's a little bit more before the central bank stop raising, and there's gonna be a plateau from there. How long is the question? And recession risk, this is still the big question mark. So what happened to the market? We had a nice bounce in July when we hit the around 6.4 level. We bounced about 5%. This was the first month since this period where you really saw durable foreign inflows. However, come the second quarter, come August, you had the market fall about 6+% in August for a total of 10.5% drawdown by the middle of September. But once it hit the 6,000 level, despite weakness in global market, you had the market rise 6%. In fact, it hit as high as 6.4 yesterday. So the question is this a dead cat bounce which will result in another down move like what you saw in August to the first half of September? Or is this the start of a durable up? So we maintain that the bull market is merely delayed and not denied. It's just there are lots of stuff that happen in between that causes the bottoming process to get extended. So just two important questions though, and this is how the presentation will progress, is why did the market fall? What caused this sharp down move here of 10%, practically correction territory? And what will bring the market back to life? And part of these are the same reasons that make it strong in July. We just need more of that, plus a lot of other global macro stuff. So let's do inflation very quickly. It hit a plateau instead of falling off a peak. So technically speaking, inflation probably peaked, but because you have some commodities rising, even though the broad basket is not going up, the three critical commodities in the Philippines are keeping it above the BSP's target range. So these three are oil. So previously, you'll see that oil has really been stuck in a consolidation between 65 and $80, and it's been hitting resistance at 80. Every time it hits 80, it pulls back. But this time it's different. For those who follow technical analysis, after breaking 80, instead of falling below it, 80 now became a new support level. And then and oil is like might try to trade in a newer range instead of 65 to 80, maybe 80 to 95. Let's see. So this is not a function of demand suddenly spiking. Demand actually remains tepid. This is due to a lot of output cuts by Saudi. Russia stopped selling diesel. It's really more on the supply side. This is very little of this is actually new demand. It's really mostly supply. That said, you're gonna have some seasonal demand ahead of China's long weekend and the winter, and that might be supportive of prices in the coming months. The other one is rice. So this one is probably the most controversial commodity here in the Philippines. And if you look at rough rice in broader future indices, what you'll realize is it's not going up as much. But the correct benchmark would actually be Vietnam rice, because this is where we import the rice from. And what you will see here And when I last presented this, I think rice was at about 520. It went up about 15% from them. So Vietnam and Thailand are basically putting export quotas. And the only way to circumvent this export quota is by paying a premium. India, on the other hand, doesn't care if you pay him more. He literally just stopped exporting. And the reason is that the El Nino weather phenomenon basically sent timing of weather disturbance, disturbed the timing of storms. So harvest season is sometimes gets hit by a strong storm and therefore yields are much lower or crops are totally destroyed, like what you saw here in the middle of the year. And that hit to supply led to trade protectionism because they wanted to shore up their own supply and therefore prices of um, net and therefore prices in the global market went up. And those countries which are net importers of rice, such as us, were the ones who are suffering from this. Storms in the Philippines also did not help the demand situation, so we became like the largest net importer of rice. The government responded with price caps. I don't know if that was effective, and also going after the hoarders. Now, what was very nice was the putting a floor on palay prices. So at least the burden is not shifted to the farmers. So at least now, that really removes the incentive from hoarders or traders to take gains from the farmers. So far, price caps have not been lifted, and harvest season has started already. So the guys who are harvesting maybe last week and maybe the next few weeks, their crops are okay. The guys who were supposed to harvest a month ago, they're the ones who had much lower yields. The next commodity that also went up is sugar. So despite the lower crop output again due to the impact of El Nino. Now you had the slower stocking of inventory, but then that caused this after inventory build. But sheer lack of supply is keeping sugar up. Now, if you exclude those three commodities, critical as they may be, and we wrote this in our Phil Equity Corner article, most raw material prices are actually on their way down already. If you look at corn, it's back to pre-war levels. You look at soybean, despite a drought in the first half of the year, which caused this spike, a lot of the rally has been undone. Wheat, you see despite the scrapping of the Black Sea Agreement, you see it's actually below that now, short-lived spike and done after 2 weeks. So wheat has gone down. So that's good for, say, instant noodles and biscuits. So we wrote about it here on September 18, about 2 weeks ago. How if you look at this, you see rice, sugar, those are really the commodities that went up quite a lot. Everything else is largely down on a year-to-date basis. Oil is up, gasoline is up, but you'll see this time around, natural gas did not follow the move of oil. So after that, after like tripling or quadrupling during the Ukraine war, it's actually lost a lot of ground. Metals, because of recession fears and a slowdown in China, are also down quite significantly. So the conclusion of our article, in which I reproduce here, is that for policymakers, this price divergence highlights the differences in inflation dynamics across commodity complexes. And for investors, understanding these nuances will be crucial for navigating markets ahead, including the impact on economic growth and stock prices. Which brings us to this. I will not belabor this point except that basically our 2Q GDP was very, very bad. It missed forecast by a lot. You see 60+% of your GDP is domestic consumption. That missed a lot. Government consumption missed as well. Fixed investment, practically flat growth on a year-on-year basis. So these big components led to GDP only being 4.3%. Maybe I think it's below forecast by 2 percentage points. So to my recollection, and this is ever since I've been working with Phil Equity and even Wealth Securities, if I exclude the COVID era, I don't recall a GDP miss this large in the past 10 plus years. It is the first time I've seen GDP miss by like 2 percentage points. And this is the result. After foreign funds started going in July, they basically went hello and goodbye and sold everything they bought and more. So the foreign inflows you saw in July, that went straight back out. And that's what caused our market to go from, so here it was 6.4 to 6,600 plus, all the way down to 6,000. So you see foreign inflows are very critical to strong movement of the Philippine stock market. And conversely, when they're selling a lot, the market also falls a lot as well. So to summarize, the move which I showed you earlier, why did the market fall 10.5% over 6 weeks? Below forecast GDP in a big way, plus high rise prices keeping inflation elevated led to net foreign selling. But fortunately, the market bounced off the 6,000 support level. So the question is, how durable will this rally be and what can make this continue? So to answer that question, we'll take a few more parts, but let's focus on what a lot of fund managers, economists, and analysts were waiting for. The main reason behind the slow deployment or conservative deployment of assets in the first half of the year was because many analysts were expecting a recession. In fact, in my previous presentations, if you recall, I've been saying the 2023 recession is the most telegraphed recession in maybe the past half century. Except that the recession didn't actually happen. So we should just be cautious, but despite the World Bank expecting a recession this year, nope, didn't happen. Who got it right? The IMF was one of those who got it right. They said we'll see slow growth. So this may be reason for caution, but again, they're not seeing a recession. I think Germany will enter a recession, UK will enter a recession, but globally, they don't see it. In contrast, you'll see despite China slowing down, Asia's still going to grow a lot faster than developed markets. The Fed on April 12th expected a recession, a mild one in the second half. Janet Yellen said, nope, we're not going to see a recession in the US. So who got it right? The IMF and Janet Yellen got it right. The US defied recession fears. Now, all I want to highlight on this slide is the reason behind the Philippines GDP miss was slower consumer spending, probably flat governments, negative growth in government spending, and flat fixed investment. What you see in the US is all of those three numbers were positive. Although there was a slowdown in your consumer spending, you see the other numbers really carried their weight. And that was great. And so see the result of their GDP again, night and day versus ours. Now, just because the recession did not happen does not mean it will not happen. So very likely, it may actually just be delayed because the Fed is adamant that the US economy cool, and they're getting part of it. Interest rates are weighing on US household formation. So these are basically monthly new home starts for privately owned homes. Yes, of course, in COVID, it's practically zero. But you'll see it rebounded, but now started to slow down. So even from the 2022 base, it's starting to slow from that. So here it's having an impact because mortgage rates practically tripled there. But jobless claims, they're still going down. So the economy is not as cooling as fast as the Fed wants, meaning likely interest rates will remain higher for longer. And this is where the assertion of Jerome Powell comes from, that inflation is not slowing down as fast as expected. The labor market is not cooling as fast as expected. Therefore, it may warrant one more rate hike. Which brings us to interest rate expectations. If recession expectations are priced in and then it didn't happen, How about interest rate expectation? So here again, you'll see something opposite from what the market expected. For recession expectations, they expected it to happen, but it didn't. For interest rate expectations, they're basically saying we do not believe the Fed. We do not think interest rates are going to hit the terminal rate set by the Fed. The Fed did 0.25 to 5.5% in a year. What were market expectations? If you look at how it moved, the market was basically looking at only 5.25%, except for this blip here when the Fed said we have a problem with inflation. But what happened here was whenever the market believes the Fed that it's going to go to 5.75, stock prices fall. Whenever the market says, you know what, the Fed can't do it, they're not going to hit 5.75%. The market actually goes up. So what actually happened after the Fed's recent pronouncement where they said, you know what, we are very likely going to 5.75. You see the interest rate expectations of investors change dramatically. I don't have the previous one, but in the previous one, they were expecting 5.25 to 5.5 and then 4 rate cuts next year. If you look at this, they're still not fully expecting a 5.75, but the number of rate cuts from 4, excuse me, the number of rate cuts from 4 has now fallen down to 3. So in effect, the market's expectation of the end interest rate for 2024 actually went up by 50 bips because it's minus 1 rate cut and it's plus 1 rate hike. So as a result of what the Fed did, we are now above the peak of the 2004 to 2007 hiking cycle. Note the bull market we had in 2009 to 2016 started after the rate cuts of this cycle. Another thing to note for those watching CNBC, watching the talking heads on TV, the move from 5 to 5.25 was said to be the last rate hike. And then they had the statistics. It wasn't. So they said the move from 5.25 to 5.5, that's going to be the last rate hike. Again, that wasn't the last rate hike either. It looks like, I guess, but high chance the last rate hike will be the November one. And that lines up exactly with what the Fed was saying, which the market did not believe for nearly a full year. The Fed was saying our terminal rate will be 5.75%. And the market said, we don't believe you, it's got to be 5 to 5.25. And the votes are transparent. So this is the most recent one, last week, September 20. You see the votes are clear. It's 5.75%. So for those saying that, you know what, the Fed may actually go 6% and above, I don't see it here in the vote. So it looks like the Fed was really going to do 5.75 regardless of what the market said. So you see it here. If the market really believed the Fed, you wouldn't have this pullback in US 10-year yields from 4.2 to, was this 3.4? And then when they said, oh no, guess what? The Fed's actually right. It's now back to 4.6. So what you see here is the market trying to fight the Fed and not believe it. But in the end, we have to adhere by the age-old maxim, don't fight the Fed. I presented this slide maybe in my past 4 or 5 presentations. I always did. The Fed said terminal rate is 5.75%, possibly 100 basis points of cuts in 2024. Can the Fed really stick to this? I always showed this slide. And most fund managers, analysts, and economists I presented to, and even those I watch on TV, did not believe the Fed's dot plot. They said the Fed cannot do this. But here we are. We're 25 basis points away, and we'll probably get there in less than 2 months' time. The sad result of that, though, going back to the Philippines, is that the BSP only has a 75 basis point spread over the Fed. And some are arguing that this may actually be too narrow. And too narrow means the peso will weaken against the dollar. And I don't want to belabor this slide, but when I do the more complex presentations, this is what I show to try to quantify where the interest rate differential is now and why it should be wider for the currency to actually strengthen. Basically, I made the dispersion of the spread of interest rates between the Philippines and the US over the past 20 years. The conclusion is it looks like the ideal post-investment grade interest rate differential is 150 to 200 basis points. We're less than half of that. If the Fed raises in November and we do not, that drops to 50. So which brings us to the reason our peso is not hitting 60 to the dollar. It's really the words, the tone, the messaging, and the actions of BSP under the new governor, Eli Remolona. So in an interview 3+ months ago, and in his presentation to them internally, he actually told them the BSP has to be structurally hawkish for a number of reasons. Because of the mix of the economy, etc., etc. And this is a significant departure from statements made by the previous central bank governor. More recently, so this is a few days ago, Governor Remolona for the first time signaled that they are going to put a line in the sand. They're gonna fight to the death at 57 to the dollar. And you see very nice words here. This guy obviously knows not only the economics on a technical basis, but also currency trading. So he said, and I quote, there are resistance levels. And when those are crossed, you'll suddenly see trades in the same direction. There's herding. For all of us here who trade, that's like basically buy and breakout. And he knows that breakout point is 57. He also said that he's open to an off-cycle increase. So again, this causes the peso to strengthen relatively. And he also said, I am staking my credibility that the BSP will not need to cut rates in the first half of 2024. So what does this tell you? He'll probably maintain the interest rate differential at 75 bips and then keep interest rates there for at least 8 months. Or 8 to 9 months before deciding if he needs to cut. So here he's following the Fed and following his own words of maintaining a hawkish stand. Now, some clients, some businessmen are wondering, why is the peso still so weak then if the BSP is so hawkish? Well, the BSP is holding the line here. For those following technical analysis, this could have been a flag or ascending triangle breakout, but the BSP is really fighting hard here. It could have actually been worse. Now, how much worse, I will show you in the following charts. But I have to remind everyone, I looked at data for the past more than a decade. The PSEI is highly correlated to the movement of the peso. Weaker peso, weaker stock market. Stronger peso, stronger stock market. So if this actually broke 57, our market may have easily broken the 6,000 support level. And that correlation is actually more than 90% in the past 3 years. So again, how much worse this could have gotten? I'll show you the next chart. We should really count our blessings. The peso, from being among the weakest Asian currencies year to date, is actually now one of the strongest against the US dollar. Before we were third from the weakest, now we're actually the fourth I'd say third strongest because I don't count the HKD. That's like a peg. So if I remove that, so behind Indonesian rupee and the Indian rupee, we're actually the third strongest already. Look at the Japanese yen, 12% down, but they like that. But look, Malaysian ringgit, South Korean won, Thai baht, all 6+% down. Developed markets, like Taiwan, down 4.8, Singapore down 2.3. I think the peso also may be a bit stronger now. I think it's just 1 1.8, because where were we today? 56.70, I think, before I presented. Now look at these charts. This is the Malaysian ringgit. Okay, double bottom breakout. Indonesian rupiah. This is a run up. This is a run up. Then you have this strong up move there. Thai baht. Okay, look at this, like higher lows, and that's basically a runaway move already. So the peso could have looked like this. So actually, our peso's looking pretty good compared to the move in ASEAN currencies recently. So why did the market go up then? The peso's at 56 plus. Yeah, not as weak as other Asian currencies, but foreign selling was there. Inflation's not great. GDP's not great. Okay. A lot of that is already in the price. On top of being a 6,000 being a strong support level, a lot of the bad news I showed you at the start of the presentation is in the price already. You have to remember the market is forward looking. So that has happened. So there are other things at play now that the market is looking at or responding to that's causing that move. And one of them just happened very recently, and that's index rebalancing. MPI's tender offer unlocks a lot of cash for institutions. Aboitiz Power's removal from the index also did the same. So basically, what happened here is, even though Bloom and Century Pacific went into the index and cash from the sale of these two went there, it's actually a net inflow into other index names, which provided a lift for your index stocks, which was more significant because the market's liquidity was low. So basically, let's say you had X going out of MPI and AP, maybe only 0.6, 0.7x went to Bloom and Century, and maybe the rest of it went into other index names. So that buying is what helped your market go up as well. So we just had some amounts here. Another rebalance is expected to be implemented this week. This is the most active I've seen the PSEI on rebalancing, again, since I started working. So after the rebalance this week, you now have nickel going in on Wednesday and Union Bank getting removed. Again, the outflow out of Union Bank will be greater than the inflow into Nickel Asia. So again, there will be more flows into your index names. Another reason I think that the market bounce is the foreign selling finally exhausted itself. So I take this from Bloomberg. This is probably the longest streak of foreign selling since the COVID era when none of us could go out. So $370 million over 24 straight days. We saw significant, and after this streak of foreign selling, we saw significant but selective foreign buying after the market hit 6,000. So this 24-day foreign selling actually culminated with the market retesting the 6,000 support level. Now, who could these foreign funds be? Most recently, again, so this was September 26th, just a few days ago, Morgan Stanley wrote a Buy Philippines report, possibly related with them putting up an office here. But here, you look at their bullish projection. They said the PSEI's market cap will quadruple over the next 10 years. So maybe this is mostly price. Maybe there'll be new listings, but quadruple in 10 years, it looks pretty good. They're using market cap to GDP metrics. They said it's underowned and cheap. I maintain this. Foreign selling is bad. It'll weigh down our market. But at this point, because we're so underowned, the impact of foreign inflows will actually be much larger than the impact of foreign outflows because there's not really much selling left. And the result of all that selling is we've become very, very cheap. When I talk to the more senior analysts, those who've been in the business like 1-2 decades more than me, the PSEI usually trades at a premium to its ASEAN neighbors, but now we're at a discount already. Okay. Well, except maybe for China because they have their own set of problems. Um, and again, look here, based again on Morgan Stanley's report, investor positioning in the Philippines is very light. Okay, and given our lack of liquidity, even a little buying, as I showed you earlier in the July move, even a little buying, I think that's maybe 15 billion in buying over 1 month, can already propel the market like 5-6%. Now, okay, sounds good. We're cheap, we're unwanted. So when you're finally wanted, the upside is great. Bad news is priced in. When will the market go up though? Now, we don't have a crystal ball to time it, but there are some things that you can look at as indicators on when the bottom of the market will happen or when the new bull market will start. So one is bull markets usually occur after a period of disinterest. And period of disinterest means volume is very low and basically no one cares about our stock market. Second is markets usually bottom before recession ends. Aha, but the recession did not happen. Third is while higher interest rates cause stock prices to fall, the lower interest rates usually lead to rising stock prices. Now, one thing I want to add here when I was presenting in 2022, I remember that was early second quarter. When I said that, a lot of people were saying this time it's different, higher interest rates will not cause stocks to fall. I was saying I've not seen a single instance in history, um, at least post Great Depression, where higher interest rates did not lead to lower stock prices. So I said, no, this time is not different. So I got flack, particularly from one client, but this was correct. It did cause stock prices to fall. So corollarily, lower interest rates will also lead to rising stock prices. Now, the thing here is there's just some timing difference on this. There are some details here before prices actually rise. But minus all those footnotes, these are the three signs we'll look for. So one, are we in a period of disinterest? Daily trading volume, the PSEI has fallen, fell to as low as 2.2 billion this year from about 7.5 billion 6 years ago. Green is the moving average. Black is the actual monthly traded value. So you see it's clearly trending lower. If you remove MSCI, FTSE, and PSEI rebalancing exercises, volume would actually be much, much, much lower. Another example, on July 19, for those who are not familiar with how trading works, normally there's matching of trades at the open, and then the first trade is at a price where there is the highest equilibrium of met bid and offers. When there is a gap, which only happens if a stock is illiquid, there is no opening trade at 9:30. And for the first time in a very long time, I saw SM had no opening trade. There was a cross, but on the board itself there was no opening trade. In fact, the first non-cross only happened 9 minutes after. So I guess yung wealth. So that's us. Like, come on, man, someone's got the trade already. Yeah, we were the very first trade that the other foreign followed. But again, that was how disinterested investors were in the Philippines, that the number one stock in our index had no opening trade for 9 minutes. So, period of disinterest, check. Where's the recession though? So, outside the US having a recession, let's assume they don't have one, what can trigger a recession? Maybe it could come from China. You have the biggest slide in bond prices. As junk bonds lost like nearly half their value. On average, some of them lost 80-90%. The default of one of the biggest asset managers for wealth management products. Some are calling it a Lehman moment. So far, it's not. AUM $87 billion. There were pickets outside Zongrong's office because people wanted their money back. And if China does not manage or ring fence its property sector, this can be actually a major risk. So what I put here is the debt distribution for the bonds of Chinese property developers. So it looks like the worst is past, but they still got a lot of that to pay. What's helping them is a lot of it are yuan bonds. So that's easier to manage because the government can call you up. But for the onshore, the offshore stuff and the US dollar stuff, that's a bit tougher. This is where a lot of investor protection can come in. So assuming we do get a recession, chances are based on economists polled 60% by middle of next year. The good thing is the market will still bottom before recession ends. If the recession doesn't happen, the market is not going to fall sharply anyway, without any other extraneous risk. But if it does happen, we can find consolation in that by the moment the recession is declared, very likely that's when we should actually start buying already. Because if you look at data over the past 80 years, the market always bottoms before the recession ends. Now, third, on the rate hikes, Goldman released a report where they showed the market behavior after the last rate hike. Now, what is critical here is it has to be actually the last rate hike, not what the market believes to be the last rate hike. So because these happened in the past, Goldman had the benefit of hindsight. So a lot of people were applying these statistics to when the Fed went from 5 to 5.25 or 5.25 to 5.5. This will only apply to the actual last rate hike of a hiking cycle. Otherwise, these statistics won't be applicable. So what did they find? Over the past 40 years, there have been 6 hiking cycles. And in the S&P 500, 3 months after the last rate hike has gained an average of 8%, and 5 out of 6 times it was positive. If you want to look at it on a longer term basis, 1 year, the S&P 500 was up the same 5 out of 6 times, but the return was more than double. 19% on average 1 year after the last rate hike. So 83% chance, I mean, people go to the casino for less than 50%. So 83%, I like those odds, those are great. I think at these odds, we should be willing to play. Last rate hike, in theory, is in November. So what will make the market rise again? Sorry, recession fears ebbing, i.e. recession doesn't actually happen, or the recession happens and it gets close to ending. Interest rates falling, ideally in the latter part of the interest rate cutting cycle, and the resulting return of foreign flows, that will be very instrumental for the Philippine stock market because we're so under-owned. In fact, there have been some opportunistic ones already. And a China recovery, be it on property or suddenly they're friends with the US again after their trade talks this weekend, or anything that can basically lift China because China is such a big part of emerging markets, like a third. So China's strength or weakness can actually affect the rest of emerging markets. I do note though, because of certain China-specific problems, China's correlation with the rest of emerging markets is no longer as high as it used to be. Still, anything good for China can only be good for the rest of emerging markets. So, what's our fair value for the PSEI? This didn't get downgraded much because of earnings. This got changed because of the new composition of our index, because you had 3 in, 3 out. So it's now 7218, 14.2 times PE at the target. That means you're trading at less than 12 times PE currently. But we're getting very close to year end. Normally, you would roll over your forecast to next year. What are we looking at? 7735 fair value for the end of 2024. That's 22% upside from current levels. And again, at that fair value, we are still very cheap. We are not expensive, and we are not like at what was the market, say, 8, 9 years ago. These are much lower valuation. So even with the 22% upside, there is a lot of margin of safety. This is not a stretch target at all. So to summarize, bad news abounds. Okay, I started with that. Key commodities are up: rice, sugar, and oil. GDP growth underwhelmed by the biggest margin in my working life, more than 2%. Corporate earnings are not rising as fast. But remember, the market is forward looking. The bad news is in the price already. The recession did not arrive. The most telegraphed recession supposedly in the past 50 years did not arrive. Or is it just delayed by 1 year? And despite investor disbelief, interest rates are set to hit the terminal rate that the Fed said they're gonna bring interest rates to when they started their 2020 this year with their report. So again, what can we learn from this? Don't fight the Fed. They're practically judged during execution as far as interest rates are concerned. The bad part there is interest rate differential is narrowing. Typically, that's bad for the Philippine peso, but the BSP is really stalwartly defending the 57 per dollar level. The result of that, and BSP Governor Remolona's statements, I think he has a chance of probably being one of our best central bank governors ever. He's a very technical guy. I like the way he speaks, the way he approaches topics. Good head on his shoulders. He's not a salesman. He knows what he's saying. Because of his statements, the peso is now among the strongest Asian currencies year to date. So the hawkish BSP plus index rebalancing plus some nimble foreign funds caused the market to bounce off 6,000 despite weakness in global markets. You had the US falling for 5 straight days, but the Philippine stock market actually went up for 5 straight days instead. You very rarely see the Philippine stock market going opposite to the US in a positive manner. Normally, the US goes down, we fall also, and sometimes the US is strong and the Philippine market still falls also. Again, because there are lots of tech stocks there. But very rarely do you see the US falling for 1 week and the PSEI actually going up for a week. We are in the middle of a long period of disinterest already, and this is part of a bottoming process. The herald of a new bull market, end of a recession, lower interest rates, net foreign inflows. Statistics indicate we have an 83% chance of a positive return both 3 and 12 months after the last Fed rate hike, the actual last Fed rate hike. And despite lower valuation multiples, we have 22% upside to fair value over the next 15 months. This is a fair value, by no means a stretch. This is not the type of target you had in the previous bull market where people keep moving the target higher to justify rising prices. No, this one is very conservative. The Philippines is quite underowned by foreign institutions, and at this point, in 2016 to 2020, 2021, we were saying foreign outflows are a major risk for stocks. The market cannot survive, cannot go back to previous valuations without them. Now, they've already sold out practically. So being underowned by foreign is more of an opportunity than a risk at this point. Now, in times of uncertainty, flight to quality is the usual trade. So we suggest buying on dips. That's what we've been doing, but we buy quality. Okay, we buy the highest quality, most liquid names, unless a stock has a really great story. Now, we don't have a very specific a broadened PL. And finally, the biggest money is made in a turn from a bear to bull market. And that's why it's very important to catch that bottom, buy, then just stay the course. I know this was ages ago, but if you look at 2009, it was a 439% gain over 7 years. half this gain happened in the first 2 years of the move. So in the next 12 months, we may actually see the best buying opportunity since 2009. So we should be very watchful for that. Once we're sure the market has bottom, we buy, we stay the course, we don't flip anymore. Just buy. So again, the biggest money is made in the term from a bear market to a bull market. I think this is just a bull market delayed, not a bull market denied. Thank you very much, everyone.